Tobias Carlisle is joining us, portfolio manager at Acquirers Fund. It's nice to see you, Tobias. Just wanted to get your take on what you're feeling on the market after this big weekend, the long-awaited G20 meeting.
The market's been extraordinarily strong, but it still remains incredibly expensive. So we're a little bit cautious, but I think it's going to keep on moving up.
Why do you think it's going to keep on moving up?
It seems to have a lot of momentum, and there's a lot of tax cuts and so forth that are driving it up.
What are some of the fundamentals that you think that actually merit it going up?
To be honest, we're looking more at the overvaluation and getting a little bit nervous about that. Schiller PE is incredibly high. Tobin's Q, on any of those metrics, it's expensive. But that doesn't seem to have mattered for 20 years.
Yeah, you were looking at, I know you have a couple of books, including Deep Value Strategy and Quantitative Value. How are you applying those ideas right now in 2019?
We're fundamental bottom-up investors, so we're looking for deeply undervalued stocks that generate free cash flow, buy back stock, and are underappreciated by the market. And on the short side, we look for the opposite, stocks that are incredibly expensive, that are losing money, burning free cash flow, issuing stock to stay alive.
Yeah, I saw you pick Netflix as one to short, and I think there are some people who agree with you. I've heard some people a little nervous about Netflix, that it has run up. It's certainly off its highs, but this is one you think maybe has run up too much, and you're thinking about shorting, right?
Right. Well, we're short in the ETF, the ticker ZIG. We just think it's incredibly expensive, and to justify that level of overvaluation, at some stage it has to start delivering on the fundamentals. And the problem for Netflix is it's got this enormous negative cash flow. So it's burning a lot of money that it spends on content. In addition to that, it carries $7 billion in net debt. So it's burning $3 billion in free cash flow. And now it's got enormous competition from Disney. It's losing The Office. The streaming is a commodity. The reason that people subscribe to these services is for the content, and that's expensive to maintain.
Yeah, you mentioned Disney, YouTube. People are looking at a lot of other things. I mean, really, it's run up about 40% this year, but you think that it could pull back even more, right?
I think there are a number of catalysts for that. When the Disney streaming goes online, that's probably the most likely point that the enormous overvaluation becomes relevant.
What about Assured Guaranteed, AGO? That goes into the financial group and has been a winner, up about 11% this year. But you like that one, right?
So we're long AGO. We think it's incredibly undervalued. It's trading at $42. Adjusted book value, which is a non-GAAP measure that the company publishes, is in the order of $87. The issue for AGO has been Puerto Rico, which is in the news, but we think that that's going to be resolved in the next 12 months or so.
Mm-hmm. How do you compare it to some of the other financials? How did you come up with this one over so many of the others?
Well, as I said, we're bottom-up fundamental investors. We're looking at what we think are the most deeply undervalued companies. We like the CEO, Dom Federico. We like the fact that it generates a lot of free cash flow and it buys back stock on a regular basis, bought back an enormous amount of stock.
All right, long on Assured Guaranteed and short on Netflix. All right, we got it. Tobias Carlisle, portfolio manager at Acquirers Fund. It's great to see you.
Thank you.